Welcome once again to Argus Weight Up Rate podcast. In this episode, we'll be delving into the intricacies of the dry bulk market. We'll analyze developments from the past quarter and leverage expert insights to explore potential future trajectories. I'm your host, Andrew Cole, Argus Asia Freight Editor, and today I'm joined by a highly respected figure in the dry bulk analysis space, Wilson Wirawan. Wilson serves as the maritime analyst for the dry bulk team lead and Pacific head at BRS Shipbrokers. Welcome back, Wilson. So let's just jump right into it and talk about the dry bulk freight market. Can you give us a sense of how things have been performing so far in 2024, particularly for Capesize Panamaxes and geared bulkers?
Thank you, Andrew, for inviting me back again on the podcast, and it's our honor and pleasure to be able to share our view on the dry bulk market to the Argus audience. Let's talk a bit on the dry freight rates in April. And I think we can start off with the simple statement that comparison is the thief of joy. So why do I say that? Well, because in Capesize, if you look at April's performance thus far and compare it to March, then it will be a somewhat disappointing one because back in March, impressive figures were printed whereby Capesize were averaging around 31.2K. And that value dropped month on month around 34% to around $20,000 and $500. But that's aside, it is worth noting that we were coming off an exceptional first quarter driven by better than expected Brazilian front haul iron ore volumes due to drier condition and amidst Red Sea disruption. Moreover, it's important to note that by the end of March, the Capesize market were experiencing a double whammy. So the first whammy is the inevitable price correction. Then you have to contend with the abrupt occurrence of the Baltimore Bridge collapse, which released units into the Atlantic market overnight. And as we're speaking, the North Atlantic market still remained oversupplied even into the last week of April, which caused the transatlantic equivalent route to drop to 10K. But despite the above-mentioned challenges, 2024 has churned out the best Capesize rates for April calendar month over the past 5 years, except 2021, of course. And that represents a 26 to 27% per annum growth rate since 2019. Now let's move on to Panamax. And Panamax entered April on a declining trend and kind of hit a floor of $14,700 on 9 to 10 April, and thereafter rebounding on the back of firm ECSA grains loading and somewhat steady Indonesian coal demand. And it's worth noting that the tighter tonnage profile in Atlantic Basin relative to Pacific Basin meant that vessels delivered in the Scout to Gibraltar range were the ones driving the Panamax rally in the second half of April. On the other hand, routes whereby vessel deliveries are centered in the Pacific region otherwise flatline, which in turn dragged the upside prospect of the time charter index. In addition, as mentioned earlier on, a robust Capesize market in March, which provided the middle-sized segment with additional tailwinds, is missing this time around. All in all, the Panamax average rates is expected to be around $16,000 in April 2024, with the compounded annual growth rate from 2019 to 2024 standing at 8.6%. And looking ahead, recent precipitation has prompted the Panama Canal Authority to proceed with plans to relax transits and draft restrictions. Starting in the second half of May, as the rainy season kicks in, the authority would permit up to 30-plus ships to transit the canal daily, which is up from the 24 ships each day during the first half of May. And already we are hearing some dry bulk ship owners contemplating for slots via auctions and submitting bids. And if this development gains some legs, that could provide some deflationary pressure for Kamsarmax and Panamax units heading into June. And last but not least, we have the Supramax and Handysize. So I would like to say that slow and steady had been the trademark for geared bulkers in April, with upward momentum visibly picking up in the second half of the month. In fact, as of 24 April closing, the Supramax index printed around $16,000, which is actually on par with levels last seen in December 2023, which was a pretty strong phenomenon back then. And consistent demand for Indonesian coal by India and China have pushed up the respective round wages to high 16K to low 16K respectively. It is also worth noting that the backhaul route, which tracks North China to West Africa in general, has been on an ascending trajectory. And back in Lunar New Year's, the backhaul route was around or assessed at around low $6,000. And by the end of April, it has already breached the 12,000 barrier. And according to Axis Marine data for 25 to 68K deadweight ton range, ex-China weekly loadings had hit approximately 4.2 million metric ton as of week 16 of this year, and that is the highest weekly figure ever recorded over the last 5 years. So the Supramax index is expected to average around mid 14K for this month, with the compounded annual growth rate from 2019 to 2024 standing at 11.6%, and the Handysize index likewise, the compounded annual growth rate over the last 5 years stands at 10.3%.
Thanks, Wilson, for that. So I think it's interesting that you pointed out that there was a bit of tailwind for Panamaxes. I think that's also one of the pointers was the split for Capesize cargoes. But of course, that didn't lend itself for too long. And then looking forward itself, do you have any thoughts for Q2?
So overall speaking, this quarter, the Q2 2024, should be a period of retracement and consolidation, especially for Capesize, given rates in Q1, in our opinion, have kind of run ahead of itself. And this will in turn also have some dampening effect for the Panamax subsequently. And for the geared bulkers, as we mentioned earlier on, it will be slow and steady given the ongoing disruption in the Red Sea situation, which affects more disproportionately for the smaller size vessels.
Sure, that's great, Wilson. So maybe we can, look a little bit further into the rest of 2024. There seems to be a bit of a mix of positive and negative signals. Can you maybe give us a little bit more information on that?
Well, Andrew, I think heading into the second half of the year, it is a period that offers both promise and peril. So it really depends on how do you look at which angles. So let's start off with the first angle, which is, of course, the ongoing Red Sea situation that we also discussed in the previous podcast. So just to throw a bit of data out there to kind of set the table. So according to the most recent vessel tracking data by Axis Marine, laden transits basis the first 3 load months via the Panama Canal year on year have dropped from 689 to 183 count. On the other hand, Suez Canal laden transit basis also the first 3 load months have dropped from 1,449 to 880. So we can see that indeed the rerouting effect having very tangible impact on freight prospects. And even though as of speaking, we don't have the full April figures, but based on what I've just seen, I think it will continue also the Q1 trend, and also that will be the same applies for May. And definitely we need to take a close look at Red Sea and ask ourselves, how will it develop in the second half of the year? And when we close off the first quarter of 2024, tensions in the Red Sea remain at fever pitch. On 6 March, 3 seafarers were killed in a missile attack on the MV True Confidence. The fatalities were the first in the ongoing assault on shipping by Yemen's Houthis rebel. Then, of course, we have the resurgence of Somali piracy activity, which was a prominent threat in the 2010s. And on 12 March 2024, the MV Abdullah was hijacked in the Indian Ocean with 23 seafarers taken hostage, and thankfully those hostages were released. But as we all said, right, once you manage to get your paws on piracy attacks, then you cannot dismiss the probability of it happening again. So such dynamics, we believe we can categorize into 4 drivers, basically VUCA, VUCA, volatility, uncertainty, complexity, and ambiguity that could help us to provide a geopolitical compass to navigate through these choppy waters. So for example, first we have volatility. So going back to the previous dry bulk freight rates, while the dry bulk freight rates in the first quarter of 2024 have traded at elevated and impressive levels, one thing we need to ask ourselves, is it inevitable that it would sustain this market performance heading into the second half of 2024? And it would appear that would be the case if examined via first principle thinking. Firstly, this is really the first time in shipping history that both the Panama and Suez Canal accessibility are materially impacted simultaneously for an extended period. And the chaos that the canal disruption can induce could only probably be matched by the recent memory of the unprecedented Chinese port congestion back in 2021. And secondly, it is imperative to make a clear distinction between the immediate and aftermath impact. The intermediate impact will be the one that I mentioned before, an obvious boost to ton miles, whereby the laden vessels are rerouted and opt for longer transits via the Cape of Good Hope. So for context, sailing at 12 knots, a ship voyage from the US East Coast to East Coast India via the Suez Canal takes around 34 to 36 days. Whereas if it sails via the Cape of Good Hope, the voyage duration could extend to 44 to 46 days. But let's say full transits were to resume immediately in the next couple of weeks or months, would everything simply return to business as usual? I think the likely reality is that decisions made by ship owners during the past few months will result in unintended consequences manifesting later. So let's say for the last few months, right, when these ships circumvented the canals, they do it with the understanding that after discharging, it will also take much longer to ballast back to the prior loading areas than in previous years. Meantime, we have ballasters that's unable to promptly reposition themselves from the Far East to the US Gulf via the Panama, or from the Indian Ocean to the Mediterranean or UK continent via the Suez Canal. And now ship owners will now need to factor in higher ballasting costs, which might deter or delay them in directing vessels to other loading regions without prior commitment of fixed coverage. So the collective impact of such developments means that the efficient deployment of the bulker fleet across basins to meet any anticipated transportation demand is now practically unattainable. And if there's a sudden need to export the commodity out of a key region, that will be even harder to satisfy. Hence, the feasibility of higher freight upside down the road is tangible, as positional demand-supply imbalances could become more of a frequent occurrence. Of course, we could also talk about, is there any potential downside freight risks that could take away some of the shine from the Red Sea crisis impact on freight rates? I think in the foreseeable future, employing asymmetry warfare tactics, will we see a sudden quiet or lull in Houthis' assault that will then encourage vessels to gingerly move back to the Red Sea, only for attacks to return abruptly, which catch the shipping community unguarded? And in other instances, could freight rates or the risk profile rise to an extent that makes it uneconomical or unpractical to source from distant regions? For example, recent shipments of Russian coal heading to India were reported to be loss-making due to the higher freight expenses. And unlike a few years ago, whereby commodity prices in general stood at high levels, since the start of 2024, prices of dry bulk cargoes like iron ore, coal, and grains have been weakening, which would then put a dampener on freight ceiling. Meanwhile, the Chinese economy is not out of the woods, as we all know. So let's talk about it later on in this conversation. So moving on to the second point, uncertainty. Second-order consequences, which is a series of causes in fact, meant we cannot naively extrapolate into the future solely on existing circumstances. As mentioned earlier on, there were certain operational challenges that were not contemplated, but these reared their heads after end January. To quickly recap, these challenges include the withdrawal of reinsurance players for the high-risk area, the granting of crews right to deny transit by the International Bargaining Forum, and the return of the Somali Pirate Sea around the Horn of Africa. And meanwhile, success begets success, though the wrong kind this time, and the success of the Houthis attack have emboldened them to expand their assault range. So on 14 March, the Yemen Houthi leader in a televised speech declared that the militant group will widen its assault on Israel-linked ships beyond the traditional Red Sea and the Gulf of Aden areas, vowing to target vessels passing through the Indian Ocean towards the Cape of Good Hope. So whether and when such a move would be implemented remains undetermined. In addition, I think Argos also have reported back then that very large gas carriers that had previously shifted away from the Panama Canal because of weather-related restrictions are returning, because the alternative Red Sea routes have been shut off by the Houthi attacks. And earlier on, we did mention that the Panama Canal intend to expand or increase their total transit availability. But even under such situation, if VLGCs or containers or LNG decided to compete with the dry bulk bulkers, I don't think they will be able to stand a chance. So this means that in the foreseeable future, while total transits for Panama Canal are expected to rise in the second half of 2024, we could not say for sure that there will also be a disproportionate increase for dry bulk transits. Moving on to complexity. So there is a spider web of interconnected events and actors that bring us to what we are seeing right now. For example, we have the Israel-Hamas conflict, we have the Iran financial banking of its proxies, including Houthis, and of course the US sanctioning of Iran, etc. But the trickier part is that we also face complexity trying to remedy the situation. So in a way, the Red Sea crisis could be framed as a longer-term symptom of the ineffectiveness of American foreign policy to guarantee freedom of navigation. For example, US politicians are focusing on domestic issues, notably the November's upcoming presidential election, and have divergent views on the US role and level of commitment in different regional conflicts. And it does not help that the Biden administration's credibility on military operations and deterrence is somewhat soiled by a list of mishaps, including the 2021 chaotic handling of the Afghanistan evacuation. And it's not just too long ago, it was also reported that Washington had urged Ukraine to halt attacks on Russia refinery infrastructure, fearing that it will risk throwing up the oil prices. And the net effect is that this apparent indecisiveness is that conflicts and tensions are dragged out rather than being settled quickly. Of course, there remains a silver lining amidst this sea of negativity, right? The Indian Navy, acting as a first responder, has stepped up this game by rescuing 17 crew members of the hijacked MV Ruin. And the Somalis were using the Ruin as a mothership to launch attacks on other vessels, right? The question also, again, is moving ahead, is there enough security support from other nations? And also, as Winston Churchill have also mentioned, you can always count on the Americans to do the right thing only after they have tried everything else. So this is best exemplified by the recent 95 billion package that's given to Ukraine and also to Israel. So maybe down the road, maybe in the second half of this year, maybe things will still have to get a bit worse, but maybe moving to 2025, who knows, situation could improve. And moving on to ambiguity, and the past few months have demonstrated that the Houthis have acted on incomplete, inaccurate, and outdated information, and also exercised loose interpretation to target ships. And the diverse nature of owning, operating, trading, financing a single vessel means that almost any connection can be made to the US and UK. And if the checklist of targets is ambiguous and easily tweaked to fit the changing needs of a militant group, what constitute best vessel management practices can be also thrown into doubt. Last but not least, the ceasefire talks between Israel and Hamas continue to hit a snag with the recent escalation. That has been well documented with Israel attacking Iran embassy in Syria and now Iran trying to hit it back, and everyone now speculating what will be the next move by Israel. So it's kind of like a game of ping pong in a certain sense. And even if, let's say, a truce is to be ultimately achieved, who is to say that the Houthis would simply stop attacking? So all in all, back to reality, I think that unless there's some effective military intervention within Yemen or a sudden change of heart by all affiliated parties in the Israel-Hamas conflict, I think any measures to mitigate the Red Sea crisis in the short term might be akin to an attempt to untying the proverbial Gordian knot. So while nothing is certain, I think that it will still be prudent to contemplate the likelihood of instability in the high-risk area to extending to the rest of 2024. While we do acknowledge there are some parties out there in the market who believe that the high-risk area situation would somewhat stabilize by the end of first half of 2024. In our opinion, this seems to be born out of optimism and drawing an arbitrary deadline, and hopefully things could get well. And under such key assumptions, we believe there will be a bifurcation of strategies by shipping players regarding the Red Sea transits, and that will be a problem known in the second half of the year. So we have Profile A risk takers who is going to hit to the Red Sea regardless of the risk assessment in exchange of juicy premiums, and they will just employ old tonnage. There's near scrap value to reduce the insurance costs. And on the other hand, we will have risk adverse take players who is going to just commit to rerouting, and that will require more fuel consumptions and carbon emissions via the longer distance. And sometimes they might have to speed up to play catch up or to avoid Pirate Sea attacks. And perhaps maybe in the future, they will only transit the high risk area if there's certain guarantees in the form of naval protection or Houthis assurance. But as we said, the Houthis assurance, we just need to take it with a pinch of salt. In either cases, the increment in voyage rates in dollars per metric ton will likely see a stubborn stickiness to it, just like how we are seeing a stubborn stickiness to inflation in the US.
Thanks, Wilson, for that detailed explanation on VUCA. So yeah, I think one of the takeaways is that it is pretty difficult to understand how the Red Sea geopolitics will ultimately affect freight rates. For now, it doesn't seem like it's slowing down. And one of the interesting points I think that you mentioned was that Panama Canal's expanded movement will be relatively limited for the dry bulk space, although symbolically it should be a little bit better since dry bulk vessels are able to now bid on slots. But ultimately, I think in order to better understand how the market is going to progress from here and to have a better outlook, maybe could we delve in a little bit more into China's economic health? How do you see China's projected growth impacting trade flow of various commodities in the coming months?
I think this is a very interesting question that Andrew, you have mentioned regarding China. So the quirky conundrum that is facing all of us is that, well, it's no open secret that China's economy is facing massive headwinds and will continue to face headwinds in the next few quarters or maybe even next few years. And what is interesting is that over the last few years, various Chinese industries are facing negative or poor operating margins, but at the same time, they are still holding on to their massive capacity or overcapacity and refusing to cut down on the capacity. And even if they were to do so, it's only on a marginal basis. So with capacity still ongoing, this means that we still need demand for dry bulk commodities to feed production. So maybe one example I could talk about is the China's pork industry and its relationship to the soybean demand. It is important to recognize that China's recent appetite for soybean is not really due to a structural growth in the underlying pork consumption, but due to an ironic underconsumption of the meat that prolong livestock's feeding demand. As we know, from 2022 and onwards, due to the zero-COVID measures and real estate and exports slowdown, the Chinese economy had been on a structural slowdown, which affects the consumers' purchasing power, especially the migrant and blue-collar workers. And pork consumption apparently have not kept pace with supply since China reopened last year, despite a surge of people eating out again. So, for example, farming companies that waited to sell their pigs around Mid-Autumn Festival and October holidays last fall, hoping for higher prices, instead end up feeding those pigs for longer and selling even fatter pigs onto the market at even lower prices. And with pigs kept longer than usual before slaughter, this means additional and unexpected feed demand by farmers, which partially explain why in 2023, the annual grain imports into China jumped to a new high of 161 million metric ton. In particular, October 2023 grain imports was a high of 19 million metric ton, and this is in stark contrast to October 2021, 13.5 million metric ton figures. Hence, it's important to recognize that China's recent appetite for soybean is not due to a structural growth in underlying pork consumption, but due to an ironic underconsumption of the meat that prolonged livestock feeding demand. And due to sunk cost, or what you can say prisoner dilemma thinking, some hog producers, which are now big corporate players, have not been keen on destocking after incurring high capital expenditure in farming and hopeful of margins improving should their competitors destock. And in fact, it's been reported that certain Chinese farmers are now keeping the fewest pig for breeding since 2020, with the sow herd dropping to a 4-year low. All in all, continuous losses will lead to output cuts, but it won't be as dramatic as hoped.
Thanks, Wilson. So I think it's really important to understand the bigger picture when it comes to any particular commodity for dry bulk. So like you said, increase in grain doesn't really mean that there is a structural demand for it. It could be, ironically, because of a lack of meat sales or pork sales over in China. So let's move forward to a different commodity. What do you think about iron ore then?
Well, Andrew, I do believe that the iron ore market is also facing a similar phenomenon as to what we discussed in the grains market. So similarly, the Chinese steel mills are also suffering from poor operating margins. Yet at the same time, for this year, we've seen improved shipments of iron ore heading into China. And the improved iron ore seaborne shipments is due to restocking purposes. And as of we are talking, these inventory levels have reached to a new high that is last seen on April 2022. So moving forward, another question that we need to ask ourselves, when will we see a reconciliation between negative margins and a permanent cut in steelmaking capacity, given that the steel industry will continue to face structural headwinds such as the ongoing slowdown in the real estate market, maybe increased competition in the seaborne steel export market, and also China recently have been promoting their new productive forces, which includes the electric vehicles, solar panels, and batteries, which is now facing higher scrutiny from US and the Europe market. But in the short term, I think that Capesize market not only could benefit from just a simple increase in absolute volumes, but also a tweaking of China's procuring strategy. So a lot of the news have been made of improved shipments coming out from Brazil, but actually it's not just Brazil, right? It's also other Atlantic suppliers, which include Canada, Peru, and notably Ukraine, which have been missing in the market over the last few years due to the Ukraine war. And this creates pockets of demands in the Atlantic basin, starting from the north to the south, and that creates optionality for the ship owners ballasting past Africa, and that was ultimately provide some cushioning to the Capesize market down the route.
Thanks, Wilson. I think since we are actually going down the commodity line, we've touched on grains, we touched on iron ore, and I think it's really interesting to see that there are actually pockets of demand, because I think for the most part, a lot of people have been focusing on Brazil and its drier weather. And I think to an extent, we can probably say that there will be a bit of a hit on grains because of this drier weather, but I think that's a discussion for another time. But going on, could we wrap things up on the commodity front with coal? Any thoughts on that?
So when it comes to the coal market, we also see a change in dynamics for this year. So back in 2023, Russian coal has found a market in Far East, but this year, Russian coal has been pretty uncompetitive as the discounts that is given has become less important as the overall seaborne coal prices drop in tandem. On the other hand, there's a fall of ton miles from Port Taman to China and Korea. On the other hand, Australia coal shipments have been picking up to the Far East. So overall, there is a net loss of ton miles coming from Capesize coal shipments, which in turn kind of take away some of the shine of the ton mile gains that is found by Capesize in the iron ore market, as we have mentioned earlier on.
Okay, great. Thanks, Wilson, for that. So, I mean, yeah, I guess overall, what you've pointed out is a pretty interesting thing. So, the market in itself has been supported quite a bit by ton mile demand because of the Suez Canal, because of the Panama Canal. But ultimately, there are certain things, pockets of, let's just say, differences in terms of each year where Russia's coal competitiveness has fallen. But I think let's just wrap things up with a slightly bigger picture in mind. Let's take a step back and just look at another important economy in the world, which is the US. One of the things I think that has changed from the start of the year is the outlook on inflation and a stronger US dollar. How might these macroeconomic factors influence dry bulk commodity prices in the second half of 2024, considering they are expected to be weaker compared to 21 and 22?
Yeah, I think the first point that we can take note is that might be a possible revision of GDP growth forecast for various countries in the second half of the year, because at the start of the year, a lot of the economics projections for these countries or developing countries have actually considered the possibility of at least a few interest rate cuts. So that is one angle to look at, and that might kind of impede their consumption appetite. And as we mentioned, or as we always have mentioned, we cannot just rely on China as the sole savior for the dry bulk demand. We need to look at other economies such as Europe. We need to look at other advanced economies such as Japan, Korea, and Taiwan. And over the last few years, these both trading blocks have experienced negative trend in their dry bulk imports. So obviously, a rise in USD interest rates doesn't really bode well from that perspective. A second point that maybe we could make is that with USD getting strong, it means that renminbi yuan is also getting weak, and that could be an issue for imports coming in to China. And also, it's not just an issue for China, right? It's also an issue for other countries, let's say Japan. And Japan to USD have dropped to a recent low of 1 to 155. And for context, back in 2021, when we have this astronomical rise of freight rates, it's also not just purely due to port congestion in China. Against the wider macro backdrop, the USD interest rate and the exchange rate were also at a relatively lower point that also helped to stimulate consumption.
All right, that's great. Thanks so much, Wilson. That's all the time we have today, and this wraps up another episode of Argus Weight of Freight. Big thank you again to Wilson Wirawan for sharing his valuable time and insights on the dry bulk market. If anyone's interested in learning more, please head over to the Argus Media website for details on our freight and commodity services. Our reports provide daily assessments and in-depth commentaries. And for even more free freight content, feel free to visit the Weight of Freight website and be sure to subscribe so you don't miss a future episode. Until then, take care and stay safe.